Hi everybody, my name is David Gully. I'm from Bentley University, and this is the third in a series of videos on central bank communication, and this particular video is about forward guidance. So we have a whole series of videos on this particular topic. We also have a series of videos on our YouTube channel, Bentley University EC391. Please visit that and have a look at the other videos that we've recorded. So this particular video, we're going to try to define what forward guidance is, give a whole bunch of examples, and then discuss some of the particular issues and risks involved when central banks try to use forward guidance. So a super quick summary here in terms of what we've covered in our first two videos. Over about the last 20 or 25 years, central banks have dramatically increased the scale and the scope of their communication. And they've done this mostly to try to help them accomplish their monetary policy objectives. For example, one of the main things they want to do is try to manage the expectations of the public. And as we'll discuss in more detail in our next video in this series, expectations of the public can dramatically improve or detract from a central bank achieving its objective. They also want to be able to build credibility of a central bank, and then also finally to create transparency and meet requirements of being a reputable institution. So first, what is forward guidance? What do we mean by forward guidance? So I'm taking this from the European Central Bank. So if a central bank gives forward guidance, it means it is providing information about its future monetary policy intentions. So the whole purpose here is to communicate with the intent of influencing the expectations of the public with respect to the stance of future policy. Now, generally, this involves the central bank's short-term policy interest rate, but it's important to note here they can use it with other policy tools as well. So why did central banks start using forward guidance? Well, prior to the Great Recession, the Federal Reserve, in fact, most central banks, used a short-term interest rate as their main policy tool. The Fed, of course, uses the federal funds rate. Well, during the Great Recession, the Fed and a bunch of other central banks, they pushed their short-term policy rates down to what's referred to as the zero lower bounds. In other words, they can't really go any lower. Well, that didn't appear to be enough to help the economies, and so they invented what are now referred to as unconventional policy tools. And there were two types of unconventional policy tool: large-scale asset purchases, which we have a whole series of videos on those, and then in this particular video, forward guidance. And so there's also two types of forward guidance in general. I'm pulling this from a very interesting paper from 2012, what's referred to as Delphic forward guidance, and this is from the Oracle of Delphi from ancient Greece, publicly states a forecast of macro performance and likely or intended monetary policy actions based on the policymaker's potentially superior information about future macroeconomic fundamentals and its own policy goals. In other words, if a central bank has information that the rest of the public doesn't have, it's important for the central bank to communicate that information to the public so the public can improve its understanding of what the central bank is doing and how the economy may evolve. There's also Odyssean forward guidance. And this is, again, the ancient Greece story of Odysseus. In contrast, does publicly commit the policymaker, just as Odysseus committed himself to staying on a ship by having himself bound to the mast in order to not be tempted by the call of the sirens. The objective here is if they can commit to a policy and get the public to buy into it, that will improve current economic conditions. Because again, that's what a job of a central bank is, to influence for the better current economic conditions. And the Fed, it's important to note here, is engaged in both Delphic and Odyssean types of forward guidance. So aside from breaking down forward guidance by Delphic or Odyssean, you can break it down by date-based or data-based. So date-based guidance indicates the time period that a policy or particular policy will remain unchanged. And data-based guidance indicates the circumstances under which a policy will remain unchanged. And this is also sometimes called state-based guidance. And it turns out the Federal Reserve, and again, lots of other central banks, have used both types, date-based and data-based forward guidance. So what we're going to do here is we're going to focus on the Fed's commitment regarding the federal funds rates, its short-term policy instruments. So in December 2008, the Fed lowered the target range for the federal funds rate down to, at the time, was referred to as the zero lower bound, 0 to 0.25%. And they used some specific language here. weak economic conditions are likely to warrant exceptionally low levels of the federal funds rate for some time. Now, they didn't specify the exact length of time, but what they were trying to do is to get across the idea that it will be a while or a long time until the Fed raises the federal funds rate again. Well, they found that this didn't work too well because it was somewhat vague and people weren't sure, well, was it really for a long time? So in March 2009, they got rid of the for some time language and they used other language for an extended period to try to communicate that it's going to be for a really long time. Well, again, the problem is it's relatively vague. It's not, their public is not sure how long an extended period actually is. So we've got two versions now of the Fed's first attempts at forward guidance. So they said, gosh, well, the third time around, can we do something better? And so they tried to. So what they did here is they tried to commit to some more specific date-based language. So for example, in August 2011, they committed to keep the federal funds rate at the zero lower bound until at least mid-2013. In January 2012, they said, okay, not mid-2013. They've now going through late 2014. And then by September 2012, they've extended it out now to mid-2015. So notice the pattern here. They keep pushing the date back. And so the idea here is you're thinking, well, gosh, maybe the Fed is really communicating strongly that it's going to keep the federal funds rate low for a really long time. And isn't that a particularly good thing? After all, that's what the Fed's objective is. Well, let's think about what the Fed is actually trying to get the public to buy into. So what they're trying to do is get us probably to buy into two ideas. The first, that they're going to commit to pursuing an expansionary policy for a really long time. You can count on them, in other words, not to raise rates. This is going to help the economy improve, and we'll discuss this a little later here in the fourth video that we'll do. So you can go out and spend, and that should improve the overall economy. Their other objective here in keeping short-term rates low, or committing to keep short rates low, is that that also helps to keep long-term rates low. And we're going to explain this in a little more detail in just a minute here. And lower, longer-term rates should work to increase consumption, increase investment, and therefore work to increase aggregate demand. So that's what the Fed wanted us to buy into. Well, here's the issue. Is it possible that they could have been communicating something else? Well, yes. What they maybe have been telling us, accidentally of course, is that the economy is so weak that we needed to keep pushing back the time of liftoff. In other words, moving the interest rate off of the zero lower bound. And of course, not surprisingly, that's not what they wanted to communicate. But the fundamental problem in all central bank communication is very, very straightforward. Is a central bank can intend to communicate a particular message or objective, but the public at large, we're free to interpret this in any way that we'd like. And so this is the basic fundamental problem in central bank communications. So the Fed tried a different tactic. So instead of date-based language, they tried data-based forward guidance. So the committee now anticipates, based on its assessment of these factors, that it will likely be appropriate to maintain the current range of the federal funds rate well past the time that unemployment rate declines below 6.5%, especially if projected inflation continues to run below the committee's 2% longer run goal. All right, so now this is again data-based. Well, they solved the problem of potentially communicating the economy is going to be weak for a while. So excellent, so great, no problem. But here's the difficulty. By solving one problem, they created another problem. So when the Fed introduced this new language, Fed officials, Ben Bernanke and others, went out and gave speeches. And what they did is they described that 6.5% unemployment rate as a threshold. That's their exact words they used. So the idea is, well, once the unemployment rate gets to 6.5%, this will be an option or a position to evaluate the stance of policy. The difficulty, though, is financial markets looked at that 6.5% and said, well, once the unemployment rate hits 6.5%, the Fed's going to raise interest rates. And so, in other words, financial markets interpreted that 6.5% not as a threshold, but as a trigger. And so what happened in late 2013 and early 2014, the economy was improving and the unemployment rate was dropping ever closer towards 6.5%. And there was a lot of consternation that the Fed was going to, once the unemployment rate hit 6.5%, was going to raise interest rates. And so the other point here I want to make is that nuances of policy are sometimes very difficult to get across. All right, so what we want to now take a look at is, well, how does forward guidance actually possibly work to impact the economy? So let's do this. Let's take a look at Ben Bernanke's very famous and very well done 2013 speech. And so what he did is he noted that you can take longer term nominal interest rates and break them down into three separate components: an average of short term expected real interest rates, what's referred to as a liquidity or sometimes a term premium, and the average expected inflation rate. The liquidity premium is the extra yield you have to offer buyers of long-term debt instruments to hold those long-term assets because those long-term assets have extra risk. And so what we can do is we can sort of look at where this comes from by using two basic concepts: the standard Fisher equation and the concept of the term structure of interest rates. And by the way, we do have a whole video on the term structure of interest rates elsewhere on our YouTube channel. And so the Fisher equation says you can break a long-term rate, a long-term nominal rate to be specific, into two parts: a real component and kind of like an inflation premium. In other words, if the expected inflation rate over the life of a 10-year bond is expected to be, say, 3% per year, the inflation expectations component would be 3%, and that's for the compensation for the holder of that long-term debt instrument to be protected against the expected inflation. The term structure equation says what you can do is you can take a long-term rate and break it down again into two parts: the average of a whole bunch of short-term interest rates over the life of the instrument, and then this liquidity premium. In other words, the extra yield you have to give people to get them to hold a longer-term asset. So when you combine these concepts together, a long-term nominal interest rate can be thought of as the average of a bunch of short-term real rates, a liquidity premium, and an inflation premium. So how does this work with forward guidance? Well, forward guidance comes in where the central bank is committing to keep its short-term policy interest rates low for some period of time. So again, as we've talked about, the Fed experimented with various different verbiage, and to the extent that they're successful, if the average real rate is kept relatively low, that will help reduce long-term nominal rates. Combined with having a credible commitment to keeping inflation low and under control, that will help keep the inflation expectation or the inflation premium component low. And then finally, as an aside here, it turns out by using quantitative easing programs, or large-scale asset purchase, in other words, the liquidity premium is reduced. So all three of those effects combined work to push down long-term nominal interest rates. And if long-term nominal interest rates fall, that will work to increase consumption and work to increase investment, and those combined will work to increase aggregate demand, which will tend to increase employment and output. The bottom line here is this: if a central bank is successful at committing to keep a policy rate low for a long period of time, that can improve, in other words, get a timelier reduction in what's called the output and inflation gap. In other words, the difference between the target of inflation and actual inflation, and the maximum sustainable level of output and actual output. And I've discussed credibility in a previous video, but the point we want to make here is for a forward guidance commitment to work, a central bank has to be credible. In other words, they have to talk the talk and walk the walk. And the idea here is that if a central bank is credible, the public at large will believe the central bank's commitment and act accordingly. Now, moving into late 2014, the economy was getting better. And there was a lot of speculation as to when the Fed would move the federal funds rate off of the zero lower bound. In other words, when they would start raising interest rates. And so it turns out that the Fed started changing its language. So for example, in 2014, in December, it said it can be patient in beginning, so the key word beginning, to normalize the stance of monetary policy. In other words, moving the federal funds rate upward. In July of 2015, they changed further improvement in the labor market for a signal to raise the federal funds rate to some further improvement, suggesting they didn't need very much more improvement. And then in October 2015, they dumped how long it will be appropriate to maintain the target range, and then they added language whether it will be appropriate to raise the target range at its next meeting. And their next meeting turned out to be December 2015. And so what's happening here is that the Fed, through 2014 and into 2015, was pulling back from its commitment to keep the federal funds rate low for a while. And so it turns out, even without raising the federal funds rate, by pulling back on that commitment, the Fed was actually tightening policy, because what we've shown is that if they can commit to keeping a target rate low for a while, that helps keep longer-term interest rates low. But once they back off that commitment, other things equal, longer-term interest rates might start to rise again. And so what they finally did is in December 2015, they refer to what's called liftoff, and they raised the target range of the federal funds rate from 0 to 1/4% to 0.25 to 0.5%. So what we want to do here now is to talk about some of the most recent developments in forward guidance. And so again, starting in December 2015, the Fed raised its target range of the federal funds rate. Now, there was some uncertainty in terms of how quickly they were going to do this and how long this rate-raising pattern would go on. So if you've got new questions here, new circumstances, you need new forward guidance. So if we move forward to March 2017, they changed some language here. They noted that only gradual increases in the future path of the federal funds rate would be now changed to gradual increases. And they also emphasized, rather than their inflation goal, they added, for clarity, their symmetric inflation goal. Because again, remember, the Fed has a symmetric inflation target where they don't want inflation that's too high or too low. And then in January 2018, they changed gradual increases to further gradual increases. And again, this is suggesting that there are going to be fewer gradual increases. So June 2018, they dropped a very important sentence, likely to remain for some time below levels that are expected to prevail in the longer run. In other words, they're dropping the idea that the federal funds rate is going to be below its normal long-run value. And then in September 2018, they dropped the stance of monetary policy remains accommodative, suggesting that policy no longer is particularly helpful in raising aggregate demand. So again, the whole idea here is they're backing off of their commitment to keep the federal funds rate low. And what they're doing here is, in fact, tightening policy even above and beyond what they're doing in terms of raising the target federal funds range. So in January 2019, what they did here, this is very interesting, they dropped some further gradual increases, and they added, will be patient, emphasize that word there, as it determines future adjustments. So what they're going to do here with this language is suggest that, well, it might be a while before they make a policy move again. And so the point we want to make here is that they're still using, to some extent, date-based forward guidance instead of data-based. And it turns out this last policy change, where they said that they would be patient, is actually kind of like almost a loosening of monetary policy, because it signaled that for a while at least, rate increases were done. So why have they done this? Well, back in 2009, when the economy was very weak, it was very important for the Fed to communicate that they were on the job and would keep interest rates low for a while. And they could make this commitment because they knew that they were well below the long-run aggregate supply curve, and that policy was going to be really accommodative for a long time. Well, that's no longer the case. The Fed is now in a tightening phase. They might be late in the tightening phase. But also, more importantly, the economy is in the ballpark of the long-run aggregate supply curve. And so the idea here is that the Fed can't tell us for sure where policy is going to next. And so they're not trying. So what we can do here is a visual. And so back in 2009, we were in this situation. The economy is well below long-run aggregate supply, in other words, the maximum sustainable capacity of the economy. And inflation was well below the Fed's 2% target. So it was not unreasonable for the Fed to say monetary policy was going to be very accommodative for a long time. Well, fast forward to 2019, it's possible that at least in the ballpark, the economy is at something like that position there. Now, we're not sure exactly if they're at full employment, but they're certainly in the general ballpark of it right now. At this point, the idea is that the Fed can't for sure tell us where policy is going next. So in other words, it can't commit anymore to where they're going to make their next policy move, so they're not really trying to do that anymore. And so it turns out, for our final slide of material here, this is a very interesting graphic from the Federal Reserve's website. It's a very helpful summary of the various forward guidance language relative to the federal funds rate, starting all the way back at the very early part of 2009 or late 2008, all the way up through the "will be patient" language here in 2019. And so you can see that with the purple language here, the purple text, is that the Fed, here's the 2013, 2014, and the 2015 language. The Fed has had to, over time, change the language it uses to describe its perceived view of how policy might change over time. And that's been necessitated by changing economic circumstances. So in summary here, the Fed, along with a lot of other central banks, began using forward guidance during the Great Recession. The whole intent of forward guidance is to influence the expectations of the public regarding the future behavior of monetary policy and also to the economy. And the purpose of that is to try to improve the current state of the economy for the better, of course. The Fed, and again, along with lots of other central banks, has experimented with both date-based and data-based forward guidance, and they now mainly, but not exclusively, use data-based forward guidance. And then finally, forward guidance goes awry. In other words, the message the central bank wants to send isn't necessarily the one that they actually send. And so in our next video, we'll look at the impact of forward guidance on financial markets and the economy. Thank you.